This video is meant to explain the benefits of buying a foreclosure to first-time homebuyers and investors. We'll also explain the foreclosure process, foreclosure laws, and the different kinds of foreclosures. To start off, let's go into a few basic tips that anyone interested in buying a foreclosure should know. Unless you plan on buying a home entirely in cash, you'll probably need to take out a home loan in order to buy a foreclosure. Potential homebuyers with a credit score of 700 or higher will have the best chance of being approved for a reasonable home loan. If your credit score is below 700, you may want to consult a credit repair service to see if your credit score can be improved. Though it may seem unnecessary to incur the additional expense of having the home inspected, you may save more money in the long run. There is no guarantee that the homeowner will inform you or the lender of all the damages to the property. There may also be damages of which the homeowner is unaware. You may be sparing yourself the expense of costly repairs later. Similar to having the home inspected, running a title search may prevent you from incurring some costly expenses after buying the home. A title search will tell you if the homeowner borrowed money against the home or failed to pay property taxes. If you buy a home that does not have a clean title, you may become responsible for paying the debts and liens on the home. Some home buyers feel more comfortable hiring a real estate agent to help them purchase a foreclosure. Real estate agents with foreclosure experience may have an easier time communicating with lenders. Even if you don't hire a real estate agent initially, you may feel more comfortable hiring one to help you close the sale. The foreclosure process in each state varies depending on that area's state and local foreclosure laws. For example, a judicial foreclosure state requires that the lender sue the homeowner in order to foreclose. It is the burden of the lender in the judicial foreclosure process to prove in court that the homeowner defaulted on the loan. In a non-judicial foreclosure state, the lender does not need to sue the homeowner to foreclose. In states where both judicial and non-judicial foreclosures are practiced, the foreclosure process followed depends on whether the home loan contained a power of sale clause. This clause allows the lender to bypass the judicial process if the homeowner defaults on the loan. Now we'll explain a little more about the foreclosure process and how it differs in a judicial and non-judicial state. In a judicial foreclosure state, the foreclosure process begins when the homeowner defaults on the mortgage. If the debt is not paid back in a timely manner, the lender issues a lease pendens, alerting the homeowner of the default and the lender's intent to sue. In a non-judicial foreclosure state, the foreclosure process begins when the homeowner defaults on the deed of trust. If the debt is not paid back in a timely manner, the lender issues a notice of default to the homeowner. This alerts homeowners of their default and gives them a time frame during which they can alleviate their debt. When the lender issues a lease pendens or notice of default, this signals the start of the pre-foreclosure period. During this period, the homeowner has a few options to prevent foreclosure. The best option is to pay the lender back in full. This option allows the homeowner to keep the home and prevent credit damage. If this isn't possible, the homeowner may seek loan modification. The homeowner can arrange to meet with the lender or work through a HUD counselor to try and arrange a new payment plan. This allows the homeowner to continue paying off the home loan to the lender at a more affordable rate. Homeowners determined to keep their homes may opt to file for Chapter 7 or Chapter 13 bankruptcy. While some assets may be seized, homeowners are not usually required to relinquish their homes through these types of bankruptcies. However, a bankruptcy will damage the homeowner's credit more than a foreclosure would. Finally, homeowners who cannot pay back or modify their loans and are not willing to file for bankruptcy may opt to sell their homes as short sales to prevent foreclosure. This is when the homeowner makes an agreement with the lender to sell the home for less than it is worth in order to use the money to pay back the lender. If the homeowner fails to alleviate the default after a certain amount of time has passed, the lender will seek to foreclose. In a judicial foreclosure, the lender sues and takes the homeowner to court. If the lender proves that the homeowner defaulted on the loan, the judge will sign off on a notice of foreclosure sale, the lender forecloses, and the home is listed for sale at auction. In a non-judicial foreclosure, the lender will seek to foreclose on the property if the homeowner has failed to alleviate the debt after a certain amount of time has passed. The lender will usually issue a notice of trustee sale. This informs the homeowner of the foreclosure and allows the trustee to list the home for sale at auction. Once the auction period has begun, the home has officially gone into foreclosure. A sale date will be scheduled for the auction where potential home buyers can bid on the house. The homeowner may have up to 5 business days prior to the sale date to alleviate the debt. Auctions can be canceled or postponed with little notice, so always contact the seller named in the listing. Foreclosure auctions tend to be very fast-paced, so it can be easy to get caught up and bid more than you should. To make sure you don't fall victim to a bidding war, try attending a foreclosure auction as a spectator before attending an auction where you plan to bid. Witnessing the bidding process firsthand will help prepare you for what to expect when you make your offer. Sometimes foreclosure homes fail to sell at auction. This may be because the home failed to reach a minimum acceptable bid or because the lender itself was the highest bidder. When this happens, the home is considered a real estate owned or REO property. This signals the start of the REO period. During the REO period, the lender may attempt to sell the home itself. Smaller lenders may hand REO homes off to third-party real estate agents. However, larger lenders, such as banks with dedicated REO departments, will often list foreclosures themselves. This allows home buyers to buy foreclosures directly from the bank. When homes with government-backed loans, such as those offered through HUD, FHA, or VA, are foreclosed on, they become government foreclosures. Government agencies will usually buy homes backed by government loans that fall into foreclosure. A benefit to buying government foreclosures, such as those sold through the VA, is that they are often well maintained. In a judicial state, it may be required that a foreclosure auction be conducted by a local sheriff. These type of foreclosure auctions are referred to as sheriff sales. Foreclosure auctions are the most common type of foreclosure sale. This benefits home buyers because it gives them a plentiful amount of foreclosure homes from which to choose. While some foreclosure auctions may be too fast-paced for some, home buyers can be very successful at auction if they predetermine their maximum bid beforehand. Base your maximum bid on the prices for which similar foreclosures in the area sold at auction. Remember to subtract the cost of needed repairs and liens on the property from your maximum bid. One major benefit to a short sale is that it benefits all parties involved. As the home buyer, you receive a new home in which to live or invest. The homeowner is able to alleviate the debt with the lender. The lender receives the remaining amount of money owed on the mortgage or deed of trust. Unlike auctions, which may occur too quickly to allow time for the property to be inspected, short sales allow the home buyer time to have the property appraised and checked for damages. Having the home inspected can spare you the expense of unexpected repairs later. Remember to ask the lender and homeowner for permission before hiring an appraiser and/or contractor. Homeowners benefit the most from short sales by being able to walk away from their debt with less damage to their credit. While short sales will negatively affect their credit, they cause less damage than foreclosure would. In turn, filing for bankruptcy would allow them to keep their houses, but would cause more damage to their credit than foreclosure. Real estate-owned or REO foreclosures allow home buyers to buy homes from lenders directly. Some home buyers and investors may like the directness of buying homes from lenders rather than from homeowners or auctioneers through short sales or auctions. Since REOs are at the end of the foreclosure process, there's no rush to buy before the end of the period. Government foreclosures through HUD, VA, and FHA can also be great deals for home buyers and investors. As mentioned before, government foreclosures, such as those sold by the U.S. Department of Veteran Affairs, tend to be very well maintained under government ownership. Government foreclosures may be an option for buyers who are not interested in fixer-uppers.